Kitco Mining special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
A clear and compelling case for gold stocks. This is Paul Harris for Kitco Mining at the BMO Metals, Mining and Critical Minerals Conference in Hollywood, Florida in the United States. And joining me this morning to discuss this is John Hathaway, Senior Portfolio Manager at Sprott Asset Management. John, welcome to Kitco.
Thank you. Glad to be here.
Gold has closed at over the US $2,000 per ounce mark for 11 straight weeks. It's been a fantastic 3 months for the physical metal, but gold equities continue to be in a slump. Why is that?
It's hard to answer it in a couple of words, but you have to go back almost to a decade ago when gold peaked out around 1900. Then it went into kind of a nuclear winter, big correction, and now has come back to be trading at record highs. Over that period, the average price of gold, which is what the gold companies that produce gold translate into revenue, has gone up 24%. The GDX, VanEck Gold Miners ETF, has actually gone down over 40%. So a 60% disparity. So it's not just recently, it's been going on for a long time. As to the reason for it, number one reason is the creation of a gold-backed ETF, which cannibalized demand for gold stocks. Reason number two is that the industry has proven itself to be a poor allocator of capital, generated poor returns on investment. That could all change in a flash with a higher gold price, and it's beginning to happen. So those are the two biggest things that I would point to.
You recently published a white paper called Gold Mining Stocks, a Clear and Compelling Investment Case, in which you talk of their extreme undervaluation, their divergence from the gold price, their profitability being set for a sharp improvement, chronic underinvestment, and many other things. Can we unpack some of those? Why do you think the setup is so good for the gold equities now?
The number one thing, and I would just point to BMO research on this, using their implied gold price, which is basically the price at which an investor would recover the market cap of a company at the prevailing gold prices, is about a 50% discount to where gold is trading. So if gold were to trade, let's say, at $1,200 an ounce, for not for each and every company, but for most companies, you would get your investment back in over the life of the reserve life of that company. That's the steepest discount that I have ever seen. I've been doing this for 25 years. So that's not to say it couldn't go further, but it seems to me that all the reasons that the gold stocks are bombed out have been priced in. And God forbid that the gold price goes up from here. And that's another day, another conversation. But if it did, I think these stocks would be maybe across the board 3, 4, 5 baggers.
So things have got so bad that the only way is up in some ways?
Almost, yes, yeah.
Okay, the setup might be good, but will it happen? What do you think?
That's the hard question. And when? I think soon. I think we're in the final stages of a washout. The lack of interest in basically any extractive industry is poor because of the zeitgeist of the world we live in. We're all into tech and AI and that sort of thing, and resources are just a bad place to be. So a lot of companies are prevented actually from, a lot of investors can't even go into any extractive business. And the gold sector, the gold mining sector, which has a market cap of about the same amount as Home Depot or MasterCard, is tiny in the context of these capital markets. So the only folks that would be interested are generalist investors who are value investors, and there's still a few around. And it would not take much of a shift for them to make a difference. So The other thing I would point to is, and we're on the warpath on this, is for companies that are able to, that are generating free cash, and many are now, to use that free cash to buy back stocks. You are getting penalized to grow because it obviously it eliminates free cash, or can. Very few companies can fund growth internally, but some can. So stock buybacks, you're starting to see a lot of announcements of this sort. And so that's another straw in the wind that I think, will make a bottom. And then lastly, smart investors. Stan Druckenmiller, who's, legendary, has been buying Newmont and Barrick, the big cap liquid names, which would appeal to him, and he's selling NVIDIA. So that's kind of an interesting point. And then we know that also, it's all over the news, that Elliott is committing $1 billion of their $60+ billion portfolio to buying bombed out investments in this space, not just gold, but across the board.
And in terms of the smart investors, let's follow up a little bit on Elliott. They're led by former Newcrest mining CEO Sandeep Biswas, so he's obviously got his own opinions and line of sight on the gold sector, very knowledgeable. Do you see other big investors coming back to the mining space?
Well, I think yes, but right now, I mean, those are the big headline names that I could think of. Is there more interest? I think there's more tire kicking, but again, it will not take a lot of new investment flows at the same time the companies are buying back stock to generate very satisfactory returns on capital.
One thing that historically can drive investor appetite is a sort of healthy M&A, mergers and acquisition market. Last year we saw the closure of a mega deal with Newmont buying Newcrest Mining. Do you see more of that coming this year?
First of all, I would not call mergers of equals healthy. There's really very little value creation, at least in the short run, maybe over time. I would say that's generally true for MOEs, mergers of equals. I have seen a couple of smart deals in the mid to small cap space that are very accretive. And they're kind of bolt-on acquisitions. One thing some companies need to do is, if there's a heavy discount in their share price because of the jurisdiction, let's pretend it's somewhere in Latin America, to get an asset that's either near production or in production in, let's say, Canada. And we've seen an example of that with Caliber buying Valentine or Marathon. So I would call that intelligent deal making, and I think we're seeing more of that. Dundee tried to buy Oceania when they got topped out by some crazy bid from the Chinese. But there was another example of an attempt for accretive M&A. So yeah, I think where that can be done, we'll see more of it. The MOEs don't excite me at all.
I can understand why, because the Newmont deal, since they announced that their market capitalization has halved.
Right. I mean, Newmont could be very interesting just because of sheer value, but in the short run, the market didn't like it, and I think it's going to take time for them to prove out the thesis of what they did, and I think they will. But I just think it's going to take a lot more time than people have patience for.
As an investor, you don't like mergers of equals, but what else do you get frustrated about in the gold equities and the managements? What do you see there that shouldn't be there? Conversely, what do you think should be done better that isn't there?
Boy, I don't think I have enough time to answer the question. But here are a couple of things that I would suggest. One is certainly now take advantage of, if you have free cash, use it to buy back stock. That I think would be number one, and to talk about it. Number two would be, and this I think I've been doing this for over 20 years. In the last 10 years, pounding the table in these presentations that we see at this kind of conference, show whether or not you've been able to generate accretive ounces of production per share, reserves per share, that sort. You almost never see that in a presentation, and it may be because the sad truth of it is that there hasn't been accretion. But I think if managements would submit to that discipline, they might make better decisions. And the third thing, which is really not talked about very much, is return on capital. And so this industry has had a poor record of generating really competitive returns on capital. We had a conversation recently with a major company, and we asked that question, and they didn't even have that number. They had an order of magnitude, but they didn't have the number. So we know that mining is capital intensive, and when you're in the build mode, that's going to detract. But I think that if managements were able to talk more about how they generate or how they plan to generate good returns on capital, that would attract generalist investors. And you wouldn't have to necessarily have a point of view on the gold price, although that helps. But those are the three things I would mention.
Okay. Now, obviously, with share buybacks, you can potentially increase your reserves per ounce, reserves per share, because you've got fewer shares. But aren't buybacks rewarding investors for leaving your stock?
No, they're rewarding for the investors that stay with the stock. Yeah. I mean, I would show any investor the door that doesn't think the stock is a bargain. So take away their pain. But buybacks are accretive. I mean, you increase your interest in per share metrics when shares are repurchased, and especially if they're done at discount prices, which is the case today.
And John, which part of the gold equities market do you think presents the most interesting and compelling opportunity at the moment? Is it the majors, the mid-tiers, the juniors, something else?
No, the mid-tiers and juniors, particularly the mid-tiers that are in production, that are trading at heavy discounts to NAV, which I think is a very bad metric, but people use it. Low multiples of price to cash flow and free cash flow. Those are the companies that we prefer, and those are the ones that we're urging to buy back stock.
Okay. Wrapping up now, John, what are you looking forward to this year?
Oh, higher gold price and higher share prices.
Well, let's hope so. John, thank you very much for joining us today.
Thanks, Paul.
And this is Paul Harris for Kitco Mining at the BMO Metals Mining and Critical Minerals Conference in Hollywood, Florida. And if you like what you see, don't forget to subscribe.
Kitco Mining special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.